Today, I am in a place called Sand Dune Park here in Manhattan Beach. And as you guys can see behind me, they have this huge hill that has all this sand on there that people used to exercise on. It's really hard to go up, man. You gotta be in good shape to go up there. And then they have this whole little kind of like forest here in the middle of all this neighborhood, which is pretty cool. And this isn't too far away from where I was staying here in Manhattan Beach. Wanted to do a video here, especially since this is the last video you guys are gonna see from me in this area. After this, I'll be headed up to Santa Barbara. I'm gonna do a couple of videos up there for you guys. And I have a couple more days that are like unknowns. I don't really know where I'm gonna be until I get to Tiburon, California, which is up in the Bay Area. So it's been awesome staying down here. This is my longest time I've ever stayed in Southern California before. And I really like it, guys. It's been great. I don't really have anything to complain about other than it's expensive, right? But it's expensive in Miami too. One thing I can complain about that has nothing to do with California is all of the lies that we continue to see surrounding the housing market, guys. And it's just getting so old hearing all these things. And the first thing I'm referring to here is lies surrounding foreclosures, okay? Because the big headline today was foreclosure starts fell 9% in July. All right, that sounds good. That the amount of foreclosures this month is down 9% compared to last month. On the surface, that sounds like a great thing, right? Less people are going into foreclosure. We must be in this miraculous housing market rebound that everybody's been calling for. But the reality is, when you look deeper into the numbers, that's not really what's happening. It's true that foreclosure starts went down in July, 9% month over month, okay? But at the moment, we still have about 32,000 US properties in July alone with foreclosure filings, okay? And that includes default notices, scheduled auctions, or bank repossessions. And even though that number is down 9% month over month, it's still up 5% year over year. And that's the type of lie that I'm talking about, right? They're putting out true information in regards to, well, the foreclosure starts are down month over month, but they fail to mention in the headline that it's up 5% year over year, which means we're still seeing more foreclosures today than we did a year ago. And this is where the lies begin, because here's what the CEO of Adam Data says, where all this data is coming from. The slight decline in foreclosure filings we are seeing is yet another sign of a rebounding housing market, guys. This is not a rebounding housing market. I know it might look like that when you see the fact that home prices are pretty much at or above where they were this time last year, depending on your market. But you have to understand, guys, that this is temporary. We haven't really seen this market get slapped up over the side of its head yet when it comes to price declines and all the problems with the economy that haven't been felt in the housing market. But at least they do go on to say, after they lie and say that the housing market is rebounding, is they go on to say, given the US housing market remains in flux, there are still various forces at play that could either help the market continue to improve or fall into a downturn over the coming months. I just don't see how we're going to go into a situation where housing is going to go up indefinitely, guys, in perpetuity, because that's not something that's ever really happened before. But yet people are somehow thinking that this is going to happen this time. And here's the other side of this data when it comes to foreclosures, okay? Even though fewer homes have entered the foreclosure process in July than they did back in June, we actually saw a higher number of foreclosures that have been in the system for a while now that were taken over by lenders in the month of July. In July, lenders repossessed 3,332 US properties, and that's up 4% from last month and 9% from last year. So when you look at the amount of people that are actually losing their homes, not just the start of foreclosures, it is going up, guys. But if you just read the headlines in the news and watch things like that, you would never know that just by looking at this, because it seems like they're always trying to paint the picture to be more beautiful than it really is. And one of my strongest arguments of why I think the housing market still has much further to fall is because of affordability, all right? There was another story today talking about how buying costs so much more than renting now. And it really wasn't like that before, guys. When you look at how much it used to cost to own a house and look at that versus the cost of renting, there's been many instances in the past where renting a house was actually more expensive and buying was the more favorable option financially, because you could have lower monthly payments than a renter in the same neighborhood. But that is no longer the case practically anywhere. And of course, this disproportionately affects first-time home buyers, because the typical first-time home buyer only puts about a 6% down payment on average, whereas a repeat home buyer will typically put more of a 17% down payment. So obviously, the larger your down payment is, the lower your mortgage payments will be. So it can help you get closer to that number of buying versus renting. But in most cases today, even if you put a 20-30% down payment on most homes, just look at any listing on Zillow, guys, and use the mortgage calculator there and play with the numbers. And Zillow sets it at a 20% down payment by default, but bump it up to 30. Look to see what your mortgage payment's going to be. I'll bet you'll be surprised that your mortgage payment's really not going to go down by much, even with an extra 10% down, because the mortgage interest rates are so high right now. And I know this because I've done this myself many times while just looking around at different real estate here while I've been here in California, just looking at these different listings. And even if you go as far to put as 50% down payment, it can still be more expensive than renting in some cases, which is absurd, but that's what's happening. And this is how much things have changed since before the pandemic, okay? In July of 2019, a home buyer who put a 20% down payment on a property would save about $700 per month in average compared to the typical rent payment in the neighborhood. But now, according to Zillow, that same buyer who puts a 20% down payment is only saving $237 a month, which sounds incorrect to me, basically, because I haven't found any situations really, at least in my searches here, of a situation where you're going to save more by buying than you would by renting. Now, of course, there probably are areas across the country, and Zillow is using, a nationwide average here to say that you could still save $237 a month, but I doubt it, guys. I bet you 9 times out of 10, buying today is going to cost you more than renting. And mind you, that's with a 20% down payment that they're using here, and most people do not put a 20% down payment when they buy a house. In fact, if you want to buy a house today with only 5% down, now you'll be spending about $330 per month more on average, according to Zillow, than if you were to rent that same house, which is making the case to buy today a losing proposition. It's kind of hard for even me, a seasoned real estate agent, somebody that owns real estate, to see the value proposition in buying today because of this big discrepancy. And you can say, well, $330 a month is not a big discrepancy, but when you're looking at more expensive properties, those differences in the cost to rent versus buy can be tremendous. And not only does it have its effect on home buyer sentiment, we just saw some of the lowest home buyer sentiment ever, being reported that only 18% of home buyers think it's a good time to buy right now. Well, it's not just about thinking it's a good time to buy, guys. It's also about realizing you can't buy at these prices and rates. Most people are just locked out of the market, especially first-time home buyers that don't make as much money and don't have that 20-30% down payment to get into a house and potentially actually make it work. If you're looking at 5-10% down right now, good luck. It's very difficult to make the numbers justifiable. And I want everybody who's in this position right now, that say you're a renter and you're thinking about buying, but you just feel like you can't make the numbers work in the sense that, you're paying $500 more to buy a similar house than you're renting, don't feel the pressure, guys. Don't give in to the FOMO, because anybody who keeps telling you that housing will go up forever and you're never going to have a chance to buy a home ever again, that's not true. There's always going to be new inventory coming to the market, and most sellers would say that they're waiting for lower interest rates to list their property for sale, right? So when interest rates come down, probably isn't going to be anytime soon, but maybe in a few years from now, then it might be looking like a better time to buy. And in the meantime, you can take the money that you're saving in rent and stack it away towards your down payment. Put in a high interest savings account, open a CD account, buy treasury bills, invest it in the market, whatever you want to do with that money to make it grow in the meantime and keep contributing to it is a smart idea right now, if you ask me. Because the alternative is you're jumping into an overpriced market when rates are very high, and if you drink the Kool-Aid and believe that you're going to be able to refinance that house when rates come down, you're going to be sorely mistaken, because that's when you're going to see all the inventory hit the market. The economy is going to be in a worse spot than it is today, and you won't be able to refinance that house. And I feel bad for first-time home buyers, guys, because literally in 2022, only 26% of all home purchases went to first-time home buyers. So, you know, people are locked out of this right now. If you saw my video yesterday with Gina, she's a real estate agent here in Los Angeles. She told you guys how it is. She's working the market here on a regular basis, and first-time home buyers are pretty much locked out. But it's not just here in LA, it's basically everywhere, because you have the older generation of the baby boomers hanging on to all of the real estate and all of the wealth right now. And I think also this anomaly situation that we have going on right now is leading people to believe that there will be no housing downturn, because the Fed raising interest rates was supposed to make home prices go down. Well, then why are home prices still so expensive, Michael? Well, it's because of sellers and their position, because we don't have the inventory, because sellers are not listing with these 7% mortgage rates. When those rates do come down, and they will, but we don't know by when and by how much, that's when you're going to start seeing the inventory come back online, guys. But you also have to remember and understand that's going to coincide with the economy not being in good shape, because the Fed is not going to start lowering rates until inflation has been squashed. And we just saw the most recent CPI report actually going back up in the other direction again. So the fight on inflation is definitely not over. And the Fed themselves has said they're not even going to be thinking about cutting interest rates until next year. And that's just a big if. And that's if things start going their way. They might not. And I know so many people will say then, well, when the inventory starts coming back and rates start coming down, Michael, then all this pent-up demand is going to come rushing back into the market and everybody's going to buy. Well, in theory, yes, that's what would happen. But if that situation coincides with the economy not doing well and unemployment on the rise, you're not going to see the buyers, guys. You're going to see the sellers saying, oh, great, finally rates are down, we can list the house. But then you're going to see all these listings come up and nobody there to buy them, because people still won't be able to qualify. Sellers are still going to be on the train of thought that prices should be still as high as they were in 2022, even though the inventory has doubled. So that's not going to work out well for anyone. The sellers who thought they were going to, make bank when everyone tries to list at the same time, coinciding with buyers who are unable to purchase because the economy is not in a good place and they don't have the job or the income to buy the house. And that's the other lie too, guys, right? They say, oh, everybody should be buying a house because it's good to be building equity, right? So that's only partially true. And the reason why that is because you have to think about something. People say renting is a waste of money. But when you're looking at the fact that owning a home costs more right now than it costs to rent one, you're actually saving money on a monthly basis, even though you're not building the equity. And if the market turns for the worst, any equity that you might build can be evaporated in the span of 6 months to a year. Because remember, your mortgage payment is mostly going towards interest if you bought over the past few years. And here's the other thing, guys. Because these property values are so high right now, you have property taxes higher than ever, along with property insurance, which are two expenses you don't have to pay as a renter. And any equity that you actually are building is also being chipped away at every single year that you have to pay that homeowner's insurance and property tax bill. Now here we have a house that's for sale for $4.3 million. They had to do a $200,000 price reduction and they listed it back in the middle of May, but they have a contract. So this house is being sold. Don't know for how much, but most likely over the $4 million mark, which is crazy that people have this kind of money. Property tax bill here is currently $35,000 a year. That's going to probably double for the new owner. I've kind of gone over some of these equations in the past of, buying versus renting and how much it costs you to rent over the years, how much it costs you to own, and then showing the difference of people who build equity and who don't, guys. But You know, the cost of homeownership is on the rise, and it's going to probably continue to rise as the values of homes stay stubbornly high, because that means you're going to be paying more for insurance and more for property taxes. And let's say you build $15,000 in equity this year, but you're going to pay $12,000 of it in property taxes. So that negates most of the equity that you built up just towards the expense of owning that home. Oh, and by the way, if there's any big expense or major repair, now you actually might be in the negative for the year in terms of how much equity you built. And that's not something that a lot of people discuss very often. It's just like that same old lie we keep hearing about the housing market. You know, you can always buy today at a higher rate, refinance later. Lie. Oh, you should buy today because you're going to be building all this equity and in the future you're going to be rich. Also a lie. At least under these circumstances, it's a lie. Things are not working in the favor of somebody trying to do that right now. And here's another lie that goes along with this, okay? Mortgage payments offer relative stability compared with renting. Now, that kind of used to be true until home values exploded. For all the same reasons I just mentioned. You have these wild card expenses now that come up out of the blue in the form of property taxes skyrocketing, or in the form of your insurance premium skyrocketing, or having to pay for damages from some sort of natural disaster that didn't come up, because now we're having more natural disasters than ever. Look what happened over in Hawaii. Nobody ever thought that they were going to lose their homes, right? But it's happening. And if you think this is over with, it's not, because it was just determined with this latest CPI reading that literally 90% of the inflation increase that we saw is due to housing, guys, in the form of all different things when it comes to housing. You have rent payments still contributing to higher inflation, okay? Housing away from home, like hotels or Airbnbs that are more expensive. You have household insurance contributing to the rising cost of shelter and housing. And everybody's like celebrating the fact that, oh, supply is low and that's keeping home prices high. Well, that might be good if you're a seller looking to cash out right now, but it definitely affects everybody else for the negative, guys, because when you have this situation, what it's doing is it's keeping inflation higher for longer. And what that means is the Fed is going to continue their fight on inflation for longer, keep interest rates higher for longer, and that's ultimately going to spin the economy into a more severe downturn for longer, okay? That's how this works, which is why I cannot understand why people are saying that we dodged the recession and we're going to be definitely going into this soft landing scenario, because it has not been achieved as of now. In fact, the most recent CPI reading is proof of that. And while you do have rents coming down substantially in some areas, overall, median asking rent prices, according to Redfin, is about $2,038 per month, which is actually up 0.3% from 1 year ago. So rents have sort of rebounded along with the cost to buy a home with this housing market run-up. And that's not good for the inflation numbers. So the point here with this is that the longer that we have this low supply problem with the housing market, it increases the likelihood tremendously that we're also going to be dealing with higher interest rates for longer, guys. And you can pretty much guarantee that the higher these interest rates go and the longer they stay this high, the more damage it's going to inflict on the economy in the long run, and we're all going to be paying for it eventually. And if you don't think insurance is going to be a huge problem, like I mentioned earlier, look at this situation with Hawaii with all the wildfires, right? You know, this is something that they didn't think was going to happen over there. It just kind of happened like a freak thing. And this is going to change how much we're all going to be paying for insurance. And I'll tell you why. Because one lesson that insurance companies are learning from this is that they're actually starting to shell out more money in claims payments for these smaller natural disasters than the big ones. So typically in the past, insurance companies were losing the most money whenever there was a big hurricane or a big earthquake, but recently they figured out that the tables are turning. Check out these stats. For the first half of this year, global insured losses from natural catastrophes stood at $50 billion compared to $48 billion in the first half of 2022. So basically the same amount. But here's where it gets interesting. Severe convective storms, which are associated with thunder, lightning, heavy rain, hail, strong winds, and sudden temperature changes, caused $35 billion of the $50 billion in damages, which is 70%, guys. Notice how hurricanes and earthquakes were not on that list of what caused 70% of these losses. Not only that, but the insured losses are almost twice as high in a 6-month period as the annual average of the last 10 years. So insurance companies are going to have to start ponying up the dough to pay out for all these losses, and guess who's going to have to start paying for it? Everybody, guys. If you are a property owner, your insurance is going to go up from this. And if you're a new homeowner, especially somebody that stretched to the max to be able to buy that home, and you have to pay an extra $2,000 a year in insurance, can you afford that? You have Allstate Insurance reporting for the second quarter of this year that they have $2.7 billion in catastrophe losses. And Travelers also lost $1.5 billion in catastrophe damages, which is twice as much than last year, guys. Travelers lost $746 million for the second quarter last year. This year it's $1.5 billion. And you think they're not going to raise your insurance rates? That's a dream, because when they start seeing an uptick in these disasters, we all pay for it regardless of where they happen. Now, some people are going to be disproportionately affected by it, because when you live in an area that's disaster prone, like Florida, for example, we get hit with much higher increases than maybe people that live in the middle of Arizona. So it says here in this story, here's what insurance companies are doing. They're shifting the focus of their business, tightening their terms, or raising prices, or both. So what that means is they're charging you more, they're dropping people altogether. We've seen different stories where people are getting dropped because of the age of their home, the age of their roof, or even just the location of their home. They don't want to insure you anymore. So these insurance companies are tightening their belt so they don't go bankrupt and go out of business. You have reinsurers that basically are insurance for the insurance companies, raising their prices as well, and that cost gets passed along to you as a policyholder. And this is starting to affect not only the insurance company's bottom line of how much money they're losing, but it's affecting their share prices too, guys, because a lot of these insurance companies are publicly traded companies. Look at Allstate. You have Allstate share price is at $112 a share right now. It's down 17% so far this year. You have Travelers Insurance that's only up 0.6% so far this year. And then Everest Insurance is only up 1.5%. versus the S&P 500 that's up 18% this year so far. So basically what this all boils down to is insurance companies are going to be much more vigilant now after this freak accident with the fire situation, and be looking at, oh, which places get the most thunderstorms, which places get the most rain, which places are the windiest, you know, and all that stuff is going to start affecting your insurance premium, guys. Whether or not you've ever had a claim, whether or not you've ever been through any sort of major disaster, it won't matter, because they have to charge all their policyholders more in order to make up for the losses that they're getting from people who are actually making the claims. And don't forget, of course, they still need to turn a profit. Insurance companies are not non-profit businesses. They're in the business to make money, guys. It's not because I just want to be, you know, on the side of the crash or whatever. I just think it's the more likely outcome. You know, I started making these videos about the housing market doing a turn back in the beginning of 2022. And the reason for that is because that's when I finally started to see the bubble. You're starting to see how high home prices went in such a short period of time and realizing that's unsustainable, okay? Anybody that's been in real estate a long time can tell you that that's unsustainable. Now, nobody knows by how much things are gonna come down or when we're gonna get all the inventory, when we're gonna get big cuts in interest rates, but you can rest assured that all that's gonna come down the pipeline at some point in the future. It's just a matter of when. So that's why I think it's okay to be renting right now, especially if you're saving money. Obviously, if it's cheaper to buy, knock yourself out. It's a smart financial decision then. But you have to decide those things for yourself, and I'm just here to guide you through it a little bit and help you make it a little bit easier to make those decisions. I hope you guys enjoyed this whole series of videos here in LA. I know I'm definitely gonna miss it here, and I will see you next time in Santa Barbara. And if you enjoyed this video, please make sure you subscribe to the channel. And if you don't wanna wait for my next video to come out, check out this one on the screen right over here, and I'll see you in the next one.